Okay, testing, testing. I believe we are live. I just need to check. Sound quality. How is the delay? It's like 5 seconds. I think the sound quality is okay. Hmm. Got my chat set up. Okay. Sure, I got all my tabs going. Tab down. There we go. Okay. I think everything's working well. How's my sound quality off? If anybody's there, let me know in the comments if everything sounds okay. Okay. I think we're good. Just give it a minute while people filter in. Okay. All right, I think I'm about ready to get started. Oh, I know what I need. Hey, Hokage. Hokage says, I know you have a plan for today, but what the hell is going on with Google? Let's go to Google. Google is ripping every single day, it seems like. You know, that's a good question. I don't have a good answer for why Google has been just absolutely ripping lately. What does this article say? Best performing member of the Magnificent Seven so far, released Gemini 3, the latest iteration of its flagship AI model. Oh yeah, I did hear that Warren Buffett unveiled a $4 billion investment into Google, so that could be, oh wait, 5 billion, sorry. And it's right on there before I even read. A $5 billion bet on Google. So, you know, Warren Buffett probably saw my stream and said, you know what, this guy's right. We should invest. And as a result, it's been popping off. And they are competing with NVIDIA. Gemini 3. How's NVIDIA doing? NVIDIA also recovering nicely. Anyway, let's get on to our plan for today. So, okay. Oh, Hokage says, I guess Warren Buffett saw both UNH and Google Streams. Yeah, maybe you're right about that. That would be funny. Okay. So in today's stream, we're looking at, generally speaking, how I'm looking to invest going forward. So we've seen recently a lot of these Magnificent Seven companies dropping down considerably in value. Let's take Meta as an example. In the last month, after earnings, Meta has dropped 17.66%. Nvidia had a little bit of a drop off, but it seems to be recovering nicely. There's a lot of people worried that the AI bubble is about to pop. Michael Burry made a big splash about his roughly $10 million bet against AI. A lot of people are worried, and it could be that we are coming into a different cycle of the economy, a slowdown. So according to BlackRock research, when we have a recovery, value companies and small companies perform very well because they're nimble. We're coming out of a recession or an economic slowdown. The smaller, more nimble companies are able to attack where the market is, I guess, most ripe in recovery. Value companies are coming back. And then when we get into the expansion phase of the economy, which we've been enjoying for a really long time, momentum and growth are in charge. We've seen this, especially when you look at the returns of the Magnificent Seven compared to the rest of the market. I remember seeing articles that basically said 7 different companies accounted for 40% of the growth of the S&P 500. Like some wild headlines. Momentum and growth are carrying the day. And then when we have a slowdown, the two factors that perform the best are quality and minimum volatility. And that is the same for a slowdown, and it's the same for a contraction. Now, if I'm worried about a market correction, the last thing I want to do is sell all my stocks, right? Because if we're wrong, which, let's face it, when people say that we're going to have a stock market crash, 90% of the time they're wrong. It doesn't happen. Like, what's the famous saying? Analysts have successfully predicted 15 out of the last 6 market crashes. Basically, they're always saying there's going to be a market crash, and then it doesn't happen. And so people who pull all their money out, they end up getting back in, missing out on a whole lot of gains. So I'm not pulling money out of the stock market. I'm simply changing the way I invest new money. And I am a little bit concerned. I did a video recently on all the different indicators that point to the likelihood of a recession in the near future in the next couple of years. It seems like it's likely, or at least more likely than normal. So I'm changing the way I invest new money. I'm focusing more on quality going forward. Why is that? Whenever the economy goes into recession, when it starts to slow down, the companies that were spending very aggressively on growth and their stock price depends on that high growth, they are the ones that fail the hardest, because when the economy is when it's not a good environment for those companies to grow, their stock price tanks because they no longer think these companies are going to grow a lot. Price corrects accordingly. But quality companies with high quality earnings, established with rock solid balance sheets, these are the companies that are going to do incredibly well even during a slowdown. They're not at risk of going out of business. They're not at risk of permanently losing market value in their company. They're going to keep chugging along. So I'm looking to invest more heavily in quality, and quality is never a bad thing, right? Even if we continue into expansion, I'm not going to be upset that I invested in high quality stocks and less focused on growth. I still want to be somewhat exposed to growth, but I'm going to be focusing on quality. And research shows that this is a really, really, it happens predictively. If you look back through history, the economy is cyclical. It repeats the same cycle again and again and again. This happens every time. So how am I going to do that? I recently picked up a 7-day free trial with Morningstar. And I got to say, I'm going to be paying for this service going forward. Not sponsored by them or anything like that. I have no no gain here from pushing Morningstar, but lately I've been looking into their analyst reports before I go into a company, and I decided, you know what, I'm going to go into the actual Morningstar screener, because one of the things that I love about these Morningstar reports, and let me show you what I'm talking about. So on my Charles Schwab, I invest with Charles Schwab. I have access. So here's one of the companies I've invested in the past, NICE. So one thing I love to look at, oops, I have my screen, bear with me here. I have my screen crunched down a lot more than I normally do. So now nothing is where I expect it to be. Okay, sorry, I had to scroll down a lot further. I've been going to this Morningstar equity report quite a bit. This is a detailed report made by Morningstar analysts, and it just has tons of really good information. And one of the things that I really like to look at is their economic moat rating, because this is, if I had to just pick one factor that points to quality, the economic moat is a huge one. It's massive. So in this case, NICE has a narrow moat. They give no moat, narrow moat, and wide moat ratings. And if I scroll down, they even give a detailed explanation for why they think this company has a moat. Now, there are, we got Farland says, what are some safety plays you are thinking about? I'm going to get into that in this video, actually, so you came to the right place. First, I'm just going to kind of go over the method behind the madness a little bit, how I find companies that I believe are going to be really high quality companies. And one of the most important things is a moat. And this isn't something that you can easily screen for. It's difficult to just screen for companies that have a moat because it's not always intuitive. There are several different kinds of moats, but in order to determine if a company has a moat, a lot of times it takes a lot of research. And Morningstar, for the companies that their analysts do cover, their analysts have done a lot of research into these companies. So for NICE, we think NICE has a narrow economic moat based on switching costs in both of its segments. So switching cost, that's a classic example of a moat when it becomes too costly for a company to go to another service. It gives their current service a lot of pricing power. They're able to continually up the price with inflation, or even maybe even a little bit faster than inflation, because it's more painful to leave them than it is to just pay a little bit more for their existing service. So switching costs is one. If we just think of a couple different types of moats really quick, you might think of like a railroad, like incredibly high capital requirements is also a form of moat. Like not many companies are going to want to go out and just build a bunch of railroads before they can even start doing business. So a company that owns a railroad, like that's a very strong economic moat. Switching costs, like we said, brand strength. So if I think of like a really strong brand, I live in Texas, so one thing I think of is Buc-ee's. Everybody loves Buc-ee's. Everybody loves H-E-B. The brand strength makes it very difficult for people to compete with those companies. So that's just to name a couple. Another one that I also want to bring up is market share. Like when you already have like a huge portion of the market share, that's also a different type of moat. So if I think about Airbnb, for instance, if I am somebody who's wanting to rent an Airbnb, or sorry, I see it even has become synonymous with renting somebody's house. If I'm wanting to rent somebody's house, I'm going to go to the website that is most likely to have a house very close to the place that I want to go. And since Airbnb already has like all the market share, they're a first mover for renting out houses, one of the first movers. I'm going to go to Airbnb because they're most likely to have the place. And then if I'm on the other side and I'm wanting to put my house up on a service to have my house rented out, the first thing I'm going to do is put my house on Airbnb because it's got the most people looking to rent out houses. So there's many different types of moats, and I hadn't really had good success finding a good screener for moats, but I think Morningstar fills that role for me so well. So anyway, I currently have the free trial, but here on the Morningstar screener, I can screen for under ratings. There are a couple things I'm screening for. Number one, I want a wide economic moat. That's number one. And then number two, I also screen for capital allocation. Now I'll do standard as well as exemplary. But strong capital allocation and a wide moat, these are the things that I want to see. And then the next step of this search criteria is I just go by sector. So one thing I'm going to start putting a little bit more effort into is organizing my investments by sector. Like currently on my stock analysis spreadsheet here, or sorry, on my investing, I invest on M1. This is my public YouTube portfolio series. Currently, I just have all of my investments lumped together. Let's go to the YouTube portfolio. We invest about $100 every week, give or take, into a different company most weeks. And yeah, right now they're just all lumped on here. So in the future, I'm going to go organize these by sector. And then going forward, I'm going to make sure that I have a good balance between all the different sectors. So it also helps to just give me a shorter list to look at. So for instance, oh, and here's an example of actually one of the companies that I've invested in. It happens to be a 5-star Morningstar company. But I will filter these by sector, gives me a shorter list, and then I will work through the list of companies that not only have a wide moat, but also have at least standard, if not exemplary, capital allocation. And then I will take the top rated companies in that section of companies and do a discounted future free cash flow analysis. Because at the end of the day, I am a value investor. And what that means is it doesn't just mean that I'm going after companies that are super cheap necessarily. What I'm looking for is a margin of safety with my investments. So whatever the analysts think is going to happen with a company in terms of their future revenue growth and their future profit growth, or whatever the market thinks, typically I tend to lean towards what the analysts' expectations are. Whatever their expectations are, I perform a discounted future free cash flow analysis on that company, given that set of expectations, and I see, does the current stock price, does it line up with that set of expectations? And is there a margin of safety? In other words, if the company doesn't quite perform to expectations, does that mean they're suddenly going to be incredibly overvalued? Ideally, I'm looking for companies that even if they underperform, they will still show undervalued according to my discounted future free cash flow model. Because what I'm looking at in terms of free cash flow, companies will eventually line up with their free cash flow, their free cash flow valuation, assuming you get all of your assumptions correct. Now, that's a big caveat. There are a lot of assumptions that go into a discounted future free cash flow valuation. And so I try to take the most conservative assumptions that I can, and that gives me a feeling of confidence. It gives me a margin of safety that my investments are going to be strong and likely to perform well in the future. And this works for growth stocks as well. You can be value minded with a growth stock, because at the end of the day, the thing that returns the most value to shareholders is more and more revenue and more earnings. Those are the two factors, like ideally earnings, but revenue growth is also strongly tied to increased stock gains. So if a company is able to continually put more and more cash in the owner's pockets, then that company is going to be worth more and more and more. Now, I love companies that grow a lot, but I'm still minding the share price. I still need to calculate if the growth that the analysts are expecting, if that comes to pass, does the current stock price support that growth narrative? So that's where we're at. That is our investing method. And I am looking at companies that, just like Farland asked, what are some safety plays I'm thinking about? This is the strategy for my safety plays. I'm looking for a strong margin of safety on high quality companies. That way, if the stock market goes down, I can be confident that these investments are not going to these companies are not going to have permanent loss of value. They're not going to have segments of their business that permanently are hurt and never recover, for instance. They're going to bounce back. So that's the kind of company that I'm looking for. So the first segment that I want to look at today is actually healthcare. So like I said, we've got healthcare on one filter. We've got ratings on this other filter. We've got wide moat. If let's just say I go with exemplary capital allocation only, and I filter for Morningstar rating, here are our top 3 companies, and Novo Nordisk jumps out at me because on the value investing subreddit, I am always seeing people talking about NVO. This is a very classic stock on value investing subreddit. A lot of people have actually been very unhappy with it lately because people have been believing that it's been a value pick for a long time. And so people have been investing in it for a long time. If we go to the 5-year view, you can see it hit its peak back in 2024, and it has been dropping and dropping and dropping. And all along this path, people have been saying, oh, now it's a value pick. Now it's a value pick. Now it's a value pick. Well, today, maybe I can catch the falling knife. We'll see. Let's do a discounted future free cash flow analysis on Novo Nordisk. And so the other element of my, where is it? The other element of my strategy here is on Charles Schwab. So unfortunately on Morningstar, I have a hard time pulling up the same detailed report that I can find very easily on Charles Schwab. But on this is where I go. I go to Charles Schwab, scroll down a bit, and right here, the Morningstar Equity Analyst Report. So what does the Morningstar analyst say about this company? 4-star company. On November 6th, Novo and Lilly announced a deal with the Trump administration to lower obesity drug prices in several channels in exchange for expanded Medicare access and tariff grace period. Both received national priority vouchers. Lilly also disclosed phase 2 data for, I'm not even going to try to say it. Well, I will. Amylin drug eloralintide. Probably butchered that. Why it matters. The dynamics of the market for diabetes and obesity therapies are changing rapidly, despite only 2 current players with a growing direct-to-patient channel, competition from unbranded compounded versions of Novo and Lilly drugs, and several challenges progressing in trials. So they're having lots of issues. As a result, their stock's been going down, but there is a lot of potential with these GLP-1 drugs in America. We have a lot of obesity, and people are always looking for easy ways to lose weight. Nobody wants to put in a lot of hard work to lose weight. I mean, it was a drug that just made it so easy and there's no downside, I wouldn't blame anybody for taking it. Whether there's side effects to this, I don't want to comment. I don't really know. I've heard that there are, but that's not my area of expertise. But there's a lot of potential here. The bottom line, we are lowering our Novo Nordisk fair value to $66 per share. So what is it at currently? It's currently at $48.49. So Morningstar analysts believe, where were we? That it is undervalued significantly. Okay, but let's go down to the economic moat. Well, no, let's look at their business strategy and outlook first. And let me zoom in a little bit as well here. A pioneer in diabetes care, Novo Nordisk has been in the business for over 85 years. It claims 34% of the 80 billion plus diabetes treatment market and roughly half of the more than 15 billion insulin market. Diabetes prevalence is expected to soar in the coming decades as a result of an increasingly overweight and aging population. That is the US. We are overweight, we are aging. And we expect Novo to maintain its wide moat as it continues to dominate in diabetes and obesity. So that is the strategy here. A wide moat. They have a huge percentage of the market share. They have brand strength. Well, actually, before I comment on the moat, let's just scroll down to what the analyst opinion is, the explanation for Novo Nordisk's moat. It accounts for 34% of the global diabetes market. We just read that, including roughly half of the insulin and GLP-1. Its strong intangible assets in diabetes and related cardiometabolic disease like obesity give the firm a wide economic moat that will shield profitability in the long run. A focused research and development strategy allows the firm to repeatedly extend patent protection through innovation. So that is the moat. They are spending we're going to get into the actual numbers, but they're probably spending a lot of money on research and development and whatever capital expenditures are required to continue that research and development. It's very hard to compete, especially when they already have the intangible assets in place, the patents, the know-how, the expertise. That is what makes this company have a wide moat. We think the firm does face environmental, social, and governance risks, particularly related to potential U.S. drug price-related policy reform. So this is a potential risk, we don't see them as material to our valuation or moat rating. So they go, the analysts go on and on. It really is a really, really good resource, Morningstar Equity Analysts. And I have been, I guess, just really enjoying this new resource that I've found. So next section, fair value and profit drivers. So we are lowering our fair value to 66 from 71 after factoring in the November 6th pricing deal with the Trump administration. So let's see. One of the first things I like to do is I like to look at what does the Morningstar analysts expect this company's revenue growth to be. So whenever I'm doing a free cash flow evaluation, I have to project all of their future free cash flows. So I generally use analyst projections for the next 5 years for revenue, and then I make some assumptions about the profitability during that 5-year period. So the profitability in this case would be the free cash flow margin, the percentage of revenue that this company is able to create free cash flow. So I'll try to take analyst expectations for what the future holds over the next 5 years. And then for years 6 through 10, I'll trim it down a bit. Now, it's very difficult to accurately predict revenues 5 years out, let alone 10 years out. So I typically will take whatever the analysts say for the next 5 years, and a lot of times I'll just cut it in half for years 6 through 10, and then I use a perpetual growth rate somewhere between inflation and the GDP growth of the country, which is the GDP growth is going to be around 4%. Inflation could be anywhere from 2 to 3. So somewhere in that range, we'll have the perpetual growth rate. So I'll take the analyst expectation for the next 5 years. I'll look at over the previous 5 years, how did this company perform? And if they perform the same way going forward, what does that imply? Now, past performance, it's never a guarantee of future results, but it is a strong indicator. A company that has performed well, that has proven that they can perform well in the past, is more likely to perform well in the future. Not a guarantee. A company that has performed poorly in the past is definitely less likely to perform well. So, okay, that's two ways I'm looking at it. Number one, what do the analysts expect going forward? Number two, if they do the same way that they did previously, what does that imply? And then the third way that I analyze a company is I change the assumptions until they are currently fairly valued. This gives me some insight into what the market believes is going to happen, what the market is implying will happen via the share price today. And so I've got these 3 different stories that I'm going to compare and see, which of these stories do I believe, and does it mean that the stock price is fairly valued over or under? So let's scroll down a little bit more. So we expect Novo to gain 50 billion of a 170 billion global GLP-1 market, ahead of the semaglutide 2032 patent expiration. GLP-1 growth drives overall 5-year forecast for 7% top line and 8% bottom line growth through 2029. Okay, so we've got some numbers here. They are saying overall 5-year forecast of 7%. So 7% revenue. We assume that U.S. prices could fall by over 20%, and they're also thinking about patent expirations. So they use a 7.5% cost of equity. We rate the why am I having a hard time? Systematic risk surrounding Novo Nordisk shares as below average. So they say below average risk. They're using a cost of equity of 7.5%. I use a cost of equity slightly higher, which makes my estimates a little bit more conservative. So keep that in mind. Okay. They also talk about risk and uncertainty. I'm going to skip past some of this. Capital allocation, exemplary, so very strong capital allocators. So wide moat, exemplary capital allocation. Lots of reading we can do. I don't want to do this all on stream because it does get a little bit tedious. So I want to just scroll down to the summary here, the numbers that I'm going to be using for my calculation. Let me just scroll down. Okay, this is where they make their predictions here. So revenue growth over the last 3 years, we have seen revenue growth of 25, 31, and 25 for an average of 27.3% revenue growth. Going forward, 5-year CAGR. So going forward, the revenue growth they're saying is going to slow down quite a bit. This is, I think this is one of the main reasons why we're seeing such a strong drop off in share price, because shareholders were seeing huge revenue increases in 2022 and 2023. And then as future projections start to change, we see lower revenue growth than maybe a lot of people expected. You see the share price go down. But 5-year average, 7.3% revenue growth. As far as their operating margins, I'm seeing operating margins hold pretty strong. So 3-year average in the past was 43.8. Going forward, it's going to be 43.2, roughly the same. Free cash flow to the firm was 29 over the last 3 years. They had really strong free cash flow to the firm over these 2 years, and then it has dropped off in 2024. The analysts expect it to recover all the way up to about 29.6, but for an average of 21. So I'm going to also assume lower profitability than we've had previously. So, well, in 2024, the profitability was actually negative in terms of free cash flow. So we will see an increase from 2024. But when I'm thinking about the average free cash flow margin over the last 5 years, I'm going to keep in mind they had really strong profitability over the last in years, 2, 3, 4. Going forward, it's not going to be as strong. So that's an important thing to keep in mind. Okay. But 7.3, that's what we're going to also keep in mind. So let's go to my automated discounted free cash flow valuation spreadsheet. So what did we say? We said, past free cash flow margin. That's the first thing I want to calculate. So their past average free cash flow margin is 24.5%. Now, I'm going to be making some adjustments to that. So right here, this is where I make some adjustments. I factor in R&D, capital expenditures, acquisitions, and stock-based compensation. I will adjust the free cash flow margin based on these 4 figures. So for R&D, since R&D is what creates the moat to some extent, especially for this company, I do give credit for some of the R&D. You could argue that 50% of their R&D should be calculated as growth spending. There's lots of different arguments that you can make. I'm going to give them credit for 10%. This is pretty well my standard for companies that are spending a lot on R&D. I give a little bit of credit, but in general, if a company like this, they have to continue to spend on R&D. They don't really get to just stop, because if they just stop, then they can't keep renewing their patents for new innovation. Like, their company really kind of relies on this R&D spending. So I only give a little bit back into free cash flow. Capital expenditures, I'm only giving back 10% on capital expenditures. Acquisitions, I'm actually taking away some of the cash flow that they spend on acquisitions. I'm taking away 10%. And then stock-based compensation, taking away 95% of the cash that goes into stock-based compensation. So in 2024, I'm seeing a free cash flow margin of 24% based on these assumptions. And then going back, I'm seeing 15, 13, 16, 22. For an average of 18 after making all these adjustments. So to be conservative, I'm going to go with a free cash flow margin of 15% for this exercise. And I already have it as that. Annualized revenue growth for years 1 through 5. The analyst said about 7.5% revenue growth. Perpetual growth rate. So I tend to do this between 2 and 3. Depending on the situation, of course. So in this case, Novo Nordisk, they are making their money off of our aging population and our obese population. The healthcare sector in general, the cost of healthcare is expanding faster than inflation. So I'm going to go with the upper end in this case. I'm going to go with 3% as my perpetual growth rate. Depending on, like, if I'm looking at a company that maybe, they're in a sector that doesn't have the pricing or the inflation that let's say healthcare does, then I might make it on the lower end, maybe 2. But in this case, because of the sector, I feel pretty good about making it 3%. And then 5 years, we'll make that 5. So we're going 7.5, and then they slow down to 5, and then they slow down to 3 for their perpetual growth rate. We have a discount rate. This is the cost of equity. Morningstar used, I think it was 7.5. I'm using 8.21. Where do I get that? NVO discount rate. So I like to use alphaspread.com. It shows me the cost of equity, and it shows me the, all right, sorry about that. No, actually, this is, I was just about to say I like using this website because it gives me good information, but this is actually not right. And actually, it doesn't really matter that I'm looking at Novo. Let's just, I mean, I could do any company because, well, I'll explain in a second. Let me just do NVIDIA really quick because I'm more confident. Yes, okay, this is accurate information. So the way they calculate their cost of equity on AlphaSpread is they take the risk-free rate and then they add to it the equity risk premium multiplied by beta. So in this case, they use 9.15. I ignore this beta calculation. This beta is indicating the stock market's volatility, or the stock's relativity. Sorry, the stock's volatility relative to the market. So I personally don't care to factor in the volatility. I just want to know, the risk-free rate plus the equity risk premium. So in this case, it's 8.25, so I can adjust accordingly. I had an 8.21. Now it is at 8.25. Something else to consider with Novo Nordisk is that their financials are in DKK, not USD. So DKK to USD, what is that conversion factor? 0.15. So I need to convert this information by 0.15. Okay. So Novo Nordisk. Oh, that's on NICE. Sorry. Wait, what is it? NVO. Got to put in the ticker. That would help, wouldn't it? Okay, which, jeez. Sorry about that, guys. So now I have to completely, yeah, Hokage, I should have read your comment sooner, man. Hokage asked, are we looking at NICE or NVO? I think you have the wrong ticker in your sheet. Yes, I do. Sorry about that. So let me just back up a little bit to let's look at the profitability one more time. Geez. So all right, 2024 profit, the free cash flow margin dropped down quite a bit. Oh, and actually, now that I'm looking at this, so now that this actually makes a lot more sense. Geez, that's embarrassing. So CapEx. So they've actually spent a lot of money recently on capital expenditures. So a huge amount on capital expenditures. So before I can say what percentage of this capital expenditure is going towards investment versus what percentage is going towards maintenance, that's the key distinction here. I need to look that up. So this percentage that I'm entering in right here, this is how much of the capital expenditure I'm giving them credit for in free cash flow. Because if they're spending money on capital that is going to increase their future free cash flow, I want to count that as free cash flow today. Even though technically when you're calculating free cash flow, generally you're taking the operating cash flow and you're subtracting out all of the capital expenditures. But I'm making an exception because, if this is going towards growth, I want to know. So how do I tell what percentage of this is growth? One way that I could determine is I could say, well, they were spending 7% and 4% in 2022 and 2021, and then they've suddenly increased it by a ton. So your maintenance doesn't just randomly go up. Generally, it goes up a lot because you're investing. So let's look at their annual report right here to see if they give us any insight on capital CapEx, which I already had. I think I had this prepared, didn't I? Capital expenditures. Geez, that's small. I need to zoom in. Okay, can we see this well enough? All right. The unprecedented scale of our capital expenditure, which includes record investments in the expansion of existing production sites, underscores our commitment to meeting the growth demand of our medicine. In 2024, work continued on major expansions of our production sites in Denmark, France, Brazil, China, and the US, investments that will ultimately enable us to reach millions more people worldwide with our innovations. So clearly they are expanding. These are growth related expenditures, not maintenance. With demand still growing, we continue to expand our product network through 2024, making significant investments in capital expenditures, and acquisitions. So let's see, there was one other blurb here. Free cash flow in 2024 was realized at $14.7 billion negative, mainly impacted by the $11.7 billion acquisition price. So they did a big acquisition, which cut into their free cash flow. But we are giving them credit for these expenditures because we believe, or I believe, this is going to give them greater free cash flow in the future. Free cash flow is also impacted by increasing capital expenditure, partially countered by net cash generation from operating activities. Capital expenditure for property, plant, and equipment was $47.2 billion compared to, in 2024 compared to 25.8, primarily reflecting investments in additional capacity. So the primary reason for the CapEx growth is growth spending. So I'm going to be giving Novo Nordisk a majority of their CapEx back. So before I do that, I'm going to go back 10 years and see what, if we go back 10 years on stockanalysis.com, how has their CapEx changed over the years? So yeah, over the trailing 12 months, 57 billion. Currency is DKK, not USD. But let's go back. So yeah, going back 5, 7, 7, 9, 8, 5, 6. This is roughly what I look at as maintenance capital expenditure. And usually I'll use a shortcut. I'll look at whatever their depreciation is. I'll say this is probably more closely tied to their maintenance spend. And then whatever the difference is between their depreciation and their actual capital expenditure, that small portion is the growth. So they depreciated by 5.4, they spent 6.3, so about $1 billion is going to be growth, and then 5.4 is going to be maintenance. But if I go to the trailing 12 months, they have 13 billion in depreciation compared to 57 billion in spending. So this is like, I don't know, 80%, 70%. But for this case, to be overly cautious, I'm going to make it 50%. So giving them credit, giving them credit for 50% of their capital expenditures, only giving them credit for 10% of their R&D, counting 10% against them for acquisitions. And that's generally because when a company does a big acquisition, they're normally paying at least a small premium. So I take away some of that acquisition cost, and then counting against them R&D. That brings my average to 38%. So the lowest on here, and that's because of this big acquisition, is 31. So I'm going to start with the average, and then I'm going to start lowering the profitability down to see how the intrinsic value reacts. So let's go with 33% free cash flow margin. I've got my predictions in here, 7.5, 3, and 5. Or sorry, let me do this in order. Years 1 through 5, 7.5% revenue growth. Years 6 through 10, 5%. Perpetual growth rate of 3%. Discount rate of 8.25. This is my return that I want to make every single year. So this projected share price, my projection, this is based on these assumptions here. Based on my projection, using the analyst expectations, I'm saying the fair share price is 92. That represents a 90% upside. That's 90% on top of my 8.25% return that I want every single year. So this is my margin of safety, this 90%. Now, if Novo is able to perform as they have on average in the past, then the fair share price is 144. Now, this is not likely, especially when we look at the analyst expectations. The analysts are not expecting revenue and profits to go up as much. So this is unlikely, but I do like to see, if they perform the same as they did in the past, what does that imply? It would be a much higher share price. Next thing I want to do is let's look at this analyst high, low, and average. So where do I get this information? We go to stockanalysis.com, go to the forecast tab for Novo, and we scroll down to the revenue growth. So out of all their analysts, we've got the highest analyst, we've got the lowest analyst, we've got the average analyst. We're going to copy this into my spreadsheet. Oh, I already had it in. Okay, so based on those expectations, this is the spread. So if the lowest analysts are correct, then the fair share price today gives me a 7% upside. If the highest analyst is correct, we're looking at 269% upside, and then the average analyst puts me at an 88% upside. So what I'm seeing here with this company is a huge margin of safety. So the next thing that I need to do is I need to look at what does it take for this company to be fairly priced. I need to start lowering my expectations to see what does the current share price imply about this company's future growth. So the first thing I want to do is reduce the free cash flow margin. We made it 38 because that's the average, but we need to make it lower. We need to make it, let's start by making it 31. Let's go with the lowest year and say that's what they're able to maintain going forward. 31% free cash flow margin. Let's say they're not able to hit 7.5. Let's just say they're able to grow with somewhere between inflation and somewhere between GDP growth. Let's just say they're able to grow their revenue by 3% every single year with lower revenue. I'm still seeing a 17% upside. And this growth pattern seems too low to me. Just based on the fact that we're talking about the healthcare sector, specifically with drugs related to diabetes and being overweight, I just can't see 3% growth. This is a sector of the economy that's going to be growing faster than that. But let's leave it at 3, and then let's drop the free cash flow margin down even further. Let's 26. No. 26.5. That puts us at about fair value. So going down from 38 down to 26.5, that's adjusted free cash flow, finally gets me to fair value. These are assumptions far below what the current analysts think. This is fair value. This is telling me that I should, after many years, if these expectations are correct, I should have an 8.25% return every single year on average by the time I sell. That's what this tells me. In my mind, Novo Nordisk is at a really good price right now. It has been falling consistently. I could wait a little bit longer, but I generally don't trade companies based on momentum. I try to be a long-term investor where, if I do the math and the company appears to be undervalued, then I invest. That's generally how I like to do my public YouTube portfolio. One more tab I want to look at is the Buffett supplement. So this is another automated part of my spreadsheet where I read Warren Buffett's book on how he analyzes balance sheets, income statements, and cash flow statement. And he looks for certain ratios. He screens for certain ratios to imply whether or not a company might have a durable competitive advantage or an economic moat. And so in this case, if the cells are green, then they imply a moat. And in this case, gross margins are, here's Warren Buffett's qualifications right here. So he wants to see gross margins over 40%, green. He wants to see selling, general, and administrative costs below 30%, check. He wants to see R&D as low as possible, close to zero, but anything over 30% would be a red flag. So even though this company spends a lot on R&D, they make so much money as a percentage of their gross, it's only 16%. So that's neutral. Interest is incredibly low. They have very low debt payment compared to their operating income. And then their profit margin, is well over 20%, implying a strong competitive advantage. Profits go up every year. Earnings per share is going up. receivables. This is something that I need to compare to other companies in the sector, but I'm going to just ignore that one. Long-term debt divided by profit is incredibly low. Retained earnings goes up every year. If we look at their inventories and their profits, they are going up together, which is really strong. That's what you want to see. Debt has recently gone up due to this recent acquisition, I imagine. But compared to their profit that they get every year, it's not going to be difficult for them to pay that off. Goodwill recently spiked as well, also in line with the acquisition. CapEx is not too high, but it's not in the green because they've been investing heavily over the last couple years. Depreciation is low and adjusted current ratio is above 1. Operating cash flow goes up every year, and they are buying back shares consistently. So all things I love to see. 100% green flags for this company. It's all going to depend on what kind of future revenue and profit do we see out of this company. As long as we're seeing above 3%, then we should make more than 8.25% per year going forward. That's the way I am valuing this company. Hokage, Nice is on a good double down opportunity as well. I do want to look into Nice because yes, it has dropped a lot. Also, Hokage says, also I'm noticing healthcare and insurance companies are making a comeback like HCA, RAGN, HGGL, and so on. Yes, indeed. They are all performing very strong. So that is a good observation. So now that you mentioned it, well, let me just say this. So NVO, this is the company I'm investing in this week. I'm spending $100 on this company. I'll be investing first thing tomorrow morning. So the current share price is, what am I getting in at? I'm getting at $48.92 roughly. Wish I would have got in at 47, but you know, I got to do my stream on Wednesday, so I try to wait to invest until after I do the stream. But let's look at Nice. So yeah, I will be investing in Novo this week. But let's do the same thing with Nice. Oh, wait, hold on. Let me see. Do I still have my Morningstar deal up? Is this Nice? No, that's Novo. Okay, here's Nice. So Nice is currently a 5-star company according to Morningstar. They have a narrow moat and an exemplary capital allocation. So they don't quite fit the wide moat category. However, this is a company I've already invested in. They have a narrow moat at least, exemplary, and they are incredibly undervalued according to Morningstar. So let's look a little bit at this one really quick. So for this one, I'm just going to scroll. I'm going to skip all the BS. I'm going to scroll all the way down to the summary, and we're just going to slap this into our spreadsheet. Let's see here. Down. Okay. So revenue growth. What does Morningstar say about Nice revenue growth? So over the last 3 years, they've grown at 12.5. Going forward, Morningstar is projecting roughly 10% revenue growth. As far as operating margin, the past 3 years has been 18%. Morningstar is saying profitability could drop a little bit, 15% going forward. So that is also something to keep in mind. Free cash flow negative. So actually, Nice recently dropped a lot in share price. Let's see what the Morningstar analyst explanation is for that share price drop. So this is the analyst note as of today, November 19th. That's another reason why I really like Morningstar's. They give up-to-date analysis. So at its investor day on November 17th, Nice released midterm guidance indicating it's heavily investing in the next few years to capture artificial intelligence driven growth. Shares have since fallen 20%. Nice EBIT, that's earnings before interest, margin will drop 5 to 6% in 2026 as it invests in cloud and AI delivery acceleration, AI product innovation, and go-to-market expansion. Improvement is expected thereafter, but we don't expect a recovery to 2024's 31% earnings before interest margin in the foreseeable future. So it's going to be a long time until this company is as profitable as they were. So that is the reason for the drop off in share price. There is a new expectation for profitability with this company. The market is shifting rapidly to AI and also internationally. These are both relatively new areas for NICE. Consequently, we expected elevated costs to be a long-term feature of its financial profile. So this is where the margin is dropping. They are seeing elevated costs, which, yeah, okay, that's I guess that's the implication. The 2026 cost increases are certain, while revenue growth is questionable, as a material inflection is not expected until 2028. We think the market reaction reflects this dynamic. Okay, so we are cutting our fair value. Oh, a huge cut in fair value. So as new information comes out, we have to adjust our expectations for our investments here. 190 from 268 due mainly to lower margin expectations throughout our forecast. Shares continue to look undervalued. Our forecast looks slightly conservative versus guidance. In 2028, we expect cloud revenue of 3.4 billion and EBIT of 25.3 versus guidance of 3.5 and 26 to 28 respectively. Okay. After several years of decelerating cloud revenue growth, we think the market has serious doubts about NICE's ability to turn the tide. So the market does not believe. Big picture, NICE's future is tied to AI. Midterm guidance implies AI revenue will grow at about a 55% compound annual growth rate, while legacy cloud revenue will only grow at 8 to 9%. NICE is well positioned as a leader in both areas, but nascent stage of the AI market injects higher uncertainty. So is there an AI bubble? If the bubble pops, then we're going to be missing out on a lot of this revenue growth. So yeah, that is the issue. Okay. So now we've kind of got a picture as to why this company has dropped in share price quite a bit. Let's just scroll back down. So I think we saw 10% revenue growth. Yep, 10% revenue growth and lower margin. So the free cash flow margin was 27.7, free cash flow margin to the firm, that is. And then going forward, they're showing it much lower, 9.2. So that is interesting. It's interesting that, I guess, because of the increase, so they're saying they're going to increase their capital expenditures quite a bit. So this is where the free cash flow is reduced because of the capital expenditure expected spending. But if that spending brings growth, which this analyst pointed out, because it's tied to AI, there's a little bit of uncertainty there. So it may not bring the growth. Therefore, with this increased uncertainty, the market's wondering, like, are we going to see a return on investment for all this CapEx spending, or, you know, is it going to be lost as they don't get the growth that they hope they would get? So, okay, let's look at this a little bit. So we go to NICE, change our rate here. So we're back in USD. So I make this a 1. Okay. Past free cash flow margin. So it's going to be dropping off quite a bit. The average is 18. I need to change this back to 10 because they haven't spent tons of money yet. Yep, those will be my assumptions. So they had 24% in 2024. The lowest that I show is 14% in 2022. So let's put 14% in there for now. Past free cash flow margin was 24 on average. Let's put 14 in there and see what we have. 10% revenue growth over the next 5 years. I'm going to cut it in half for years 6 through 10. I'm going to leave the 3% in there because AI is a growing industry. And based on that set of assumptions, I'm still seeing a significant margin of safety. Significant. Let's drop the assumptions down a bit. Let's make this 10. Let's make this 5. So this is what the market thinks. Basically, the market is saying revenue growth is going to be half of what the analysts say. Hokage says, I think you increased initial free cash flow. Shouldn't it be -10 or -14? Initial free cash flow. You talking about the initial free cash flow margin? Oh, yes, I did. I see what you're asking. Okay, sorry about that, Hokage. You're paying attention. So in the past, this whatever I put into this cell, it would add to or subtract from this number. I have since changed it. I felt like it was just easier to just type in the number that I want it to be, instead of having to like do the mental math. And I feel like for stream, it looks better too, to just say like, let's assume the free cash flow margin is 10%. And then I put in 10, you know? So that's what you're saying. So yeah, the old way, yes, I would have put in a -10 if I wanted the free cash flow to be 14, or a -14 if I wanted the free cash flow margin to be 10. But now, yeah, we're just throwing it in there. Makes sense. Yeah. Okay. So assuming 10%, super low, that's what the market is seeing right now. So to me, it looks like there is still a margin of safety with this company. I don't know that I will double down at this time. I need to do some research into exactly how Morningstar is coming up with their free cash flow to the firm. You can see right here, they're showing a massive drop off. So in 2024, let's just do a comparison. In 2024, Morningstar says 38.9% free cash flow to the firm. 38.9 on stockanalysis.com. See, 2024 is this one right here. On stockanalysis.com, free cash flow margin, they're showing 29. So yeah. And versus 39. It's just a huge difference. So something is a little bit fishy here with the margin. I think I need to do some more due diligence and really make sure that I understand what kind of profitability can we expect in the future with this company, because that's what's making all the difference. So yeah, over the next 5 years, they're saying 9, but then going forward, it should be much higher, because this -8, this -9 right here is bringing down this average. It looks like the long-term average is closer to 15 for free cash flow to the firm margin percentage. So, I mean, if we say 15, or let's go back. Yeah, let's just say 15. If we say 15 with only 5% revenue growth instead of 10%, there is still a 50%. There's a 50% margin of safety, which is pretty huge. Let's put in the analyst expectations, the range. Let's put in the whole range. Now, this data, actually, I'm not even going to put this in because this is probably old. Because this is like, the company just dropped in value like a couple days ago. So if we look at the most recent analysts, Tyler says strong buy. So we've got a bunch of price target changes: 189, 165, 130, 160, 136. Let's filter by analyst performance. 4 stars only. And then we got nearly a 5-star. Morgan Stanley and Citigroup both say strong buys. Oh, here we go. I can say all analysts or top analysts. So the top analysts still are showing really strong price targets. And revenue growth on average about 9%. So Yeah, definitely not. Let me put it this way. I'm definitely not selling my nice shares at this time, even though it's dropped quite a bit. And if I were to double down on it, I could see myself putting in another 100. But yeah, off stream, I need to do a little bit more research into the profitability, because this is the sell that's making all the difference. It could be that they, for the next 10 years, that they average 10% revenue growth, and they have a 15% free cash flow margin. And then we're looking at huge gains. We're looking at a massive upside if they hit those targets. But, if their free cash flow margin is 50% less, and then their growth rate is 50% less, then we're still, right at fair price today. So to me, it seems like a significant margin of safety as well with NICE. I'll make a decision, and next stream, I'll do some more research, and I'll make sure and touch base again with this company next week, next stream. So there you go. That's all I got for today. Unless, hey, Hokage, if you have any companies you want me to look at specifically, let me know. We can do a quick little free cash flow analysis if you're interested. Anyone else who's watching that wants me to look at a company really quick, throw it in the chat, and I'll check it out before I head out of here. Yeah, I think that's all I got for y'all today. Hope you enjoyed the stream. Hokage, you're good. Good find on NVO. I'll join the moat. There you go. Yeah, and hey, what do you think about this? I'm really liking this screener, man. Where is it? Morningstar. This, it's such a nice thing to screen for, because to think about a moat, you have to put some serious thought into a company. It's not just an automated, it's not just a metric that you can just add up off of their balance sheet. It takes some serious thinking to determine, does a company have a moat? And then this is the type of tool that I love, being able to just take a resource that professional analysts spend, hours and hours and hours on, and just leveraging their work so that I can invest more effectively, faster, better, hopefully. Wide moat, exemplary capital allocation. I'm looking for quality, and I'm looking for companies that are undervalued. That's the playbook right now. And I'm going to be going through all the different sectors. Today we did healthcare. I'm not sure what I'm going to do next week yet. Maybe I'll do consumer cyclical, perhaps. Chipotle is up there. Anyway. Hokage, it's actually good. What is their subscription cost? Lots of due diligence in one place. Exactly, man. Exactly. The subscription cost, it's not cheap, to be honest. It's not cheap. It was I want to say it was $200 something a year. So it's if you're going to use it, then it's worth it. But if it's one of those things that you just don't use that much, man, it's a big cost. It's a drag on your investment portfolio, right? $200 every year. So if you have $20,000 invested, then that's a 1% drag on your portfolio. So anyway, I think it's worth it for me. Especially because I'm doing a public YouTube channel as well, where I'm investing on YouTube. So, geez, I don't know if that came through on the mic, but my cat just cried out. Anyway, I love it. I'm a fan. I've got the free trial right now. It's 7 days. I would recommend you try the free trial, Okage, and then make a decision. But yeah, it's over $200. Might be $250. I can't remember. But what's up, Momo? Anyway, That's all I got, guys. I will see you next week. Hokage, appreciate you coming out. Have a good night, man.